Hello, welcome to this video on the size and type of firms. In this video, we're going to look at different types of businesses and how we measure the size of businesses. So let's start off with that one. How do we measure the size of a business? If you're going to talk about businesses in business economics. Well, we might look at the amount of sales, either in the number of units that they sell or how much money they receive from selling their products, which we call revenue. We might look at market share, what proportion of all the sales of that type of item are accounted for by a particular business. They might have 25% market share, for example. We might look at capital employed, how much money has been invested in the business. And this might give us an idea of the assets and the size of that particular business. We might also look at something like the number of employees. What we tend to steer away from using is profit. You might have a very large business that's not making much profit, and likewise, you might have quite a small business that's making large amounts of profit. So we would normally use sales, particularly market share, maybe capital employed, number of employees to measure the size of a business. So we talk about different sizes of business, and a term that we should get familiar with is one called SMEs. Now, SMEs, the SME stands for small and medium-sized enterprises. And so these are small and medium-sized businesses. And we can see the categorization for these types of business in this box here. A medium-sized business, we would say, has less than 250 people working for it, sales revenue or turnover of less than 50 million euros, and the capital employed less than 43 million euros. A small business, we would say, has less than 50 people and less than 10 million in terms of sales. And just to complete the story, sometimes we describe micro businesses, very small businesses, less than 10 people work for them and less than 2 million euros of revenue. An interesting stat at the bottom there, most businesses are small and medium-sized enterprises. So 99.3% of businesses in the UK are small or medium-sized, but they account for half the revenue. So what that's telling you is there's a few very large businesses, 0.7% businesses are very large businesses that account for over half of the revenue that businesses generate. Two other ways or types of business, two other categories are private businesses and public businesses. Private businesses, we say, operate in the private sector. And that means that the business is run and owned by individuals. And normally they do this to generate a profit. The key here is that the companies are not owned by the government or by the state. So these are owned by private individuals or private companies and normally are run for profit. The state doesn't control these companies. A good example would be the Virgin Group. Here we have a company that owns lots of different companies, and Richard Branson is the major shareholder, and these businesses are run to generate a profit for him and the other shareholders in the companies. A public business is one that operates in the public sector, and that is the part of the economy that is controlled and run by the state or by the government. So these businesses are owned and controlled by the state, and as a result, they're not normally run to generate a profit. An example would be the National Health Service in the UK. We often sometimes talk about for-profit businesses and not-for-profit businesses. Here's some examples of businesses that we would describe as being for-profit. So they normally operate, the vast majority operate in the private sector. Some examples would be sole traders, people going it alone by themselves, a small little business, or maybe a partnership. Private limited companies, so where they've registered the business with the government and their shareholders, or a public limited company, a very large company where shares are available for members of the public to buy and sell on the stock exchange. The aim of these businesses is often to make a profit for the owner. And these are called dividends for limited companies. So private limited companies, public limited companies will pay a dividend, the share of the profits that goes back to the owner. Obviously, they may have other objectives as well, but they will be looking to make a profit. These businesses are considered good for the economy because the profit incentive drives efficiency. I'm going to try and lower my costs, do things with the fewest resources, which we're concerned about economics, so I can make the biggest profit. Profit also drives innovation. If I come up with a great new technology and I sell lots of it, then I'm going to generate a profit. And competition. So I'm going to try and compete to make as big a profit as I possibly can with my rivals, which again fosters things like efficiency and innovation. Not-for-profit businesses are businesses, sometimes they're charities, maybe community organizations, that are run on commercial lines. So they kind of run as businesses, but they're not designed, their objective is not really to generate a profit or a dividend for the owners of the business. There are some examples down here in the bottom right-hand corner. Some of these are charities that generate money from donors, or they sell items, or different ways of generating revenue. They have costs, they have staff, but they don't try and generate a profit. They normally try and reinvest it back into the business or to whatever their objective is. In the UK, a good example would be an organisation called Network Rail. And they are the ones who are responsible for providing the track that the rail companies use. So they monitor the tracks and lay the tracks. So that's their purpose. They are not for dividend companies. So any profit, any spare money they have left over after they've received money from the train companies for using the tracks and paid out costs, that money isn't given to the owners. It's reinvested into the network, into the railway network. So companies will pay Network Rail for use of the rail infrastructure, and this business's objective is not to generate a profit, but actually to reinvest it into improving the network. Another type of business we need to be aware of is one called a social enterprise. And that again is normally a not just for profit business. So they might make a small profit and reinvest it, but the business has been created to try and address a social problem. So profits are normally reinvested for a social purpose in the community rather than the need to satisfy investors. Good examples, the Eden Project in Cornwall. There's a magazine that operates in the UK called The Big Issue, which helps homeless people get off the streets. There's a restaurant that a famous chef called Jamie Oliver opened, which was to give young people, or possibly people who've got in trouble with the law and stuff, a chance to rehabilitate by working through this restaurant. Another type of business we need to be aware of is called a cooperative. And that is where members of the cooperative are individuals who businesses who are working together to achieve a common purpose. So they normally are formed so the individuals can benefit as being part of a larger group. An example might be farmers. If you have lots of separate little farmers all trying to negotiate a price for their milk with a supermarket, they don't have much bargaining power. If they form a cooperative together and that cooperative bargains on their behalf with the supermarket, then they have a lot more power. Profits may be generated in the cooperative and then reinvested in that particular business. But it won't be their primary objective. Helping out the members of the business of the cooperative will be the number one objective. Another example is a mutual. And a mutual, often sometimes called a mutual fund, is a good example here, exists with the purpose of raising funds from its membership, which can be used to provide common services to all members of this organization. So sometimes it can be things like sort of an insurance policy. All the members will contribute money towards this business, the insurance mutual, and then if something goes wrong for one of those members, that money can be used to help them out. Another example could be some sort of investment opportunity, a mutual fund where people pool their money together, which is then invested and those returns are distributed back to the investors. So in this video, we've looked at different types of business: public, private, for-profit, not-for-profit, mutuals, cooperatives. And we've also looked at ways we might measure the different size of business, SMEs, and the concept of market share, for example. That's it. Thanks very much for listening.